the COMEX options expiration in both gold and silver. And then tomorrow is the big day as far as I'm concerned. It's the large traders that are or are not standing for delivery in their December contract. And if they're not, they have to roll over their contracts or sell them, which keeps them as futures contracts, of course. And if not, they're going to stand for delivery. And I think this is one of the big deals when you see silver in backwardation still, meaning that the cost of silver today is worth more than it is out into the future. It's supposed to be opposite of that. It tells you that there's stress and strain within the market itself, and that there's a greater demand for physical metal than there is for the paper contracts that stand behind them. And this is what we've talked about for quite some time now. It started to really come to fruition. And this is a big one here. This December contract is certainly a big one. A couple other things that caught my attention over the weekend, down again, one of which we talked about, I don't know if I talked about on your show, but talked a little bit about on others, was that the Enbridge, which is kind of up from the shadows, over the last several years, the information that I would use or find to talk about the BRICS was easier to find than it is now. It's kind of in the fog right now, if you will, and I think that's by design. They're keeping it quiet so as to not attract the attention of this administration and draw the cross-eyed look of President Trump. And one of the however, that did come to light was that UAE, United Arab Emirates, and China conducted another successful test of Enbridge, a real-time test. For those people that don't remember, Enbridge is the cross-border payment system that was designed by China, Hong Kong, Thailand, UAE, and, of course, the fifth full participant who came in a little bit later, Saudi Arabia. They're the big five, originally designed with the assistance of the BIS Innovation Hub. We talked how that went sideways when the BIS pulled out at the 12th hour. But one of the things that I find interesting, and I don't think should be overlooked, is this first trade was between China and UAE. Well, I don't think it should be overlooked that China, Hong Kong, and the UAE all run advanced precious metals markets where gold is traded in local currencies. And this enables Enbridge members to convert trade surpluses, as we've talked about, directly into gold. And this bypasses the dollar entirely. This is the ultimate plan with the Metals Exchange expansion of their vaulting system, the one that was just completed in Hong Kong. What's the significance of that? In order to take gold out of China, it has to come out of Hong Kong. So the first one was built in Hong Kong. So in an example like this, the UAE could sell oil, as an example, to China for the digital yuan over Enbridge, which settles in 7 seconds, 98% reduction in fees, no U.S. or Western intermediary banks, no SWIFT, and then they can settle imbalances in gold first without converting into dollars and take possession in Hong Kong. And of course, the second vault is under construction, or will be very shortly, in Saudi Arabia. This is where it is heading, and I think that's a important piece. A couple other things that I noticed, UBS, and again, these banks are so full of BS at UBS. They're all full of it because they continue to raise their price targets. And their price targets are as useful as a mud wall, because they've been wrong continuously, yet, okay, fine, and they acquiesce and raise it. So now UBS says, well, we're going to raise our mid-year price target to 4,500, previously 4,200. Well, geez, thanks. I think that these banks that continue to raise their targets, if you go back and look what they were a year or two ago, it's almost kind of laughable. A lot of people will talk about it. I don't even think it really bears much consideration at all. They really don't want people to know what their real belief is, and that's why you have, it's funny because I have an account with Morgan Stanley, and the guy that I work with, he's a very good friend of mine, and he manages, a lot of money with Morgan Stanley. He's one of the biggest in Florida, and he lives in my neighborhood, and he wouldn't know a gold coin if it fell on his foot, yet his chief investment officer has advocated for 20% holdings in gold, sell half your bonds. And so, it's to me, these banks and the people who work underneath them really have no clue. But when you're getting Michael Hartnett, when you're getting, again, another comment from Jeffrey Gundlach, the bond king, saying that 25% gold is not overweight. And then, of course, Michael Hartnett, as we've talked about, he's the chief analyst of Bank of America. They're talking to people above, not the successful money managers who are managing $3 billion and are at the top of their game on retail. They're talking to the people who are bringing in all the metal into the United States. They're talking to the massive traders that are doing so, and they're saying gold and silver are being, in essence, by their actions, reintegrated into the system. To me, that caught my attention. So don't pay attention to what they're saying. Pay attention to what they're doing, unless you're listening to the very, very top analysts who are speaking to the institutional traders. One other thing that caught my attention was the Ethereum founder, Vitalik Buterin. Now I'm butchering that name, but it's interesting because he was giving a speech the other day, and he says they've highlighted quantum resistance as a key element of the network's long-term roadmap. He says, this comes amid a risk of quantum computing advances that could potentially undermine current cryptographic systems. Ethereum races go to quantum safe. Speaking at DE DevConnect conference in Buenos Aires, he says, the roadmap for Ethereum includes goals for the next 2 years, warned that cryptography securing Ethereum and Bitcoin could be vulnerable to quantum computing breakthroughs by 2028. And it's interesting to me that the guy that designed Ethereum is saying that quantum computing can do this. And he was inspired to say this because the test was conducted by Google Quantum AI using their Willow quantum processor. We've talked about the Willow chip, caught my attention about 2 years ago. And, Google previously stated that the Willow chip could do in under 5 minutes what the world's fastest supercomputer could do in 10 septillion years. Now, I didn't even know what that meant. It's 10 to the 25th power. And so when you talk about reasons to, I think more than ever, to consider having something outside the matrix, outside the system, you got the guy that developed Ethereum, where it seems like everything trades on the Ethereum network, it's the rails of so many of the crypto tokens and really the rails of the entire system, much of it anyway. It goes to show how naive I am with cryptocurrency. But the point of it is that when you get the guy that is the designer saying that within 2 years you could see problems or the ability of quantum computing to hack and or steal Bitcoin and Ethereum, I found it to be very, very concerning and interesting. These things you don't hear about in the mainstream, but whatever, nonetheless.
Every once in a while I sit back, look at the world, and ask myself the same question.
How on earth do most people still rely on this system? I mean, seriously, how many warning signs do we require? How many indicators? How many enormous, flashing, neon caution signs shouting? This is not normal. Because today, what's been shaking the foundation of the global financial structure isn't some quiet, tiny issue in a back office somewhere. It's systemic, it's structural, and it's accelerating. And yet, somehow, most people continue their day like nothing is occurring because their advisor is still showing them pie charts and attractive graphs and telling them everything's fine. But beneath the surface, everything is being revalued, reorganized, and realigned. And I've been stating this for years. We're witnessing the slow, grinding breakdown of a dollar-centric world, one that began in 1944 at Bretton Woods and is now being torn apart in front of us. Not overnight, not with a bang, but with a sequence of tremors, each larger than the previous. And if you know what to look for, the tremors are everywhere. Let's begin with the most misinterpreted thing over the last 2 decades, the yen carry trade. People hear the words carry trade and zone out. Sounds too technical, but in truth, it was the world's massive, artificial, magical, zero-cost piggy bank. Borrow yen for almost nothing, convert it into dollars, and run around purchasing everything under the sun. Tech stocks, emerging markets, crypto, bonds, private equity, commodities, you name it. If it moved, people bought it with Japanese yen. And this continued for nearly 30 years. 30 years. That's not a trade. That's generational leverage. But now Japan has done the unimaginable from their viewpoint. They lifted rates, finally. And suddenly, this enormous, invisible safety net that has been holding up global risk markets is being pulled away. Imagine trying to land a plane after you realize the landing gear was never actually down. That's where we are right now. Trillions, literal trillions, are in positions financed by yen that no longer function. And as Japan steps in to protect its currency, those trades begin to unravel. When they unravel, people require yen. To acquire yen, they need to sell the assets they bought. U.S. Treasuries, S&P 500 index, tech stocks, long-duration bonds, even crypto. This is a chain reaction. And here's the part most people don't understand. Once this unwinding starts, it accelerates on its own. You can almost hear the mechanisms grinding. Higher yen dropping U.S. markets, rising treasury yields, more selling pressure, more yen purchasing, more unwinding. A feedback loop, a fire that feeds on itself. And the irony is that many financial advisors, the same ones who told their clients for years that gold is a barbarous relic, have absolutely no clue how large this carry trade truly is. They have no idea that their clients' assets are resting on top of a global leverage framework they don't even comprehend. And then you combine that with what's occurring in the sovereign bond markets. Do you realize that Japan owns over $1 trillion in U.S. treasuries? And for the first time in decades, Japanese government bonds actually yield something. That alone breaks the math of the carry trade. If you can earn 3.5% risk-free at home, why hold 4% treasuries halfway across the planet, denominated in a currency that's losing purchasing power? Add in currency conversion costs, hedging costs, and geopolitical risk, and suddenly the so-called risk-free U.S. Treasury isn't risk-free at all. And what happens when Japan begins dumping treasuries to repatriate funds? Rates increase. And when rates increase, everything sitting on top of that rate structure, stocks, real estate, corporate credit, venture capital, private equity, begins to shake. And here's the truth nobody wants to say out loud. We have built a society, an entire economic model on low rates. This economy is a skyscraper built on toothpicks. And now those toothpicks are cracking. But this isn't just Japan. It's not just the carry trade. This is a global pattern. China is cutting treasuries. Saudi Arabia is cutting treasuries. Brazil is cutting treasuries. Even Switzerland and Belgium, historically dollar-friendly regions, are trimming their exposure. The dollar's biggest supporters are quietly saying, "Thanks, but no thanks. We'll take the gold instead."
Significant this carry trade truly is, because for years the world was able to borrow a Japanese yen at 0% interest rates. So investors would borrow the yen in trillions of dollars. It's the biggest trade in terms of arbitrage that the world has ever seen. For a very long time, Japan kept interest rates at zero, and investors would borrow cheap yen, and then they convert it into dollars. And they use that money to buy U.S. stocks and bonds or emerging market assets or whatever they wanted in Europe or wherever. And whatever they earned in dividends and interest, these gains were pure profit because the loan cost them nothing. But now Japan has raised interest rates, and their currency is the rates and the value of the dollar strengthening. The trade has become uneconomical. You have 1.1 trillion in Japanese pension funds that are sitting there now, in essence, in a trade that doesn't make sense. And what's interesting is that now that the yen is strengthened, in order to convert back, they would have to buy yen at a higher rate when they bought it at a lower rate. And as they liquidate bonds in the United States, the treasuries that they're holding, 1 trillion of them, to bring it home to cover these positions, not only will interest rates go up here in the States, but all of that money going into the yen will push the yen up higher. And now you have a big, big problem. It's systemic. It's a chain reaction. And what the higher rates can do to this economy, and all of that money that is poured into treasuries and crypto and into equities is now beginning to unwind. And I think it's something people need to understand, that the selling pressure will trigger falling prices. And these falling prices, I think, will start to really, really very quickly put some of these trades upside down. And this is how you get this unwinding, this spiraling. And I think we're right there right now, because, that this yen trade represents trillions globally, and hundreds of billions of it sitting in the U.S. stock market alone. So I should watch this very closely. Their next meeting is coming up in December, and a lot of people think that they're going to raise rates again. And if that's the case, um, you know, I think leading into the end of the year could be some massive fireworks. So those are the couple of things that I saw that caught my attention, and happy to take it any way you'd want. Japanese, I think it's their 40-year bond, is at the highest rate since its inception. It's like 3.5%, or real close to it. And so at some point, the Japanese will say, geez, we can buy our own bonds instead of getting, and the 30-year treasury is what? Barely 4%, right around 4.
The U.S.
Yeah, U.S. And when you figure in the fees and everything for switching, it doesn't make sense anymore. There's 1.1 trillion in U.S. treasuries that Japanese own, and so they're going to have to liquidate them to keep their accounts from blowing up, which pushes our rates up. And that's why the Fed keeps talking about, they've lowered rates, but the 10-year treasury is not moving. Why? Because they're strained. The rest of the world is selling treasuries.
The part that gets me every single time is how predictable this system is when you zoom out. It always looks complicated.
When you zoom out, it always appears complicated when you're standing inside the turmoil. But when history evaluates it, the pattern is always the same. Excessive leverage, synthetic liquidity, complacency, valuations that defy gravity, a trigger, and suddenly the system that was stable becomes violently unstable. And right now, the trigger isn't just one thing. It's 5 things occurring at the same time. The yen carry unwind, the global central bank gold accumulation, the bridge settlement revolution, the collapse of commercial real estate, and the Fed's invisible return to money printing. Most people can handle one shock, but 5 all converging. That's when you get a systemic reset. And the institutions understand this. They're not foolish. They're just deceitful with the public because telling the truth would unravel confidence. And confidence is the only glue left holding this together. You want an example of how delicate confidence is? Look at the COMEX. I've been shouting about this for years, and finally the cracks are appearing. When you see backwardation, where spot silver costs more than future silver, you're looking at stress. Real stress. Stress that signals people want metal now, not promises of metal in the future. Stress that says we don't trust the system to deliver. And when that happens in a market that is supposed to be the most liquid, most stable, most dependable futures market on the planet, that's not a minor glitch. That's an alarm bell. Backwardation is not supposed to happen in monetary metals. These markets are built on arbitrage. The idea that people are willing to pay more for immediate delivery means the foundation underneath the futures market is weakening. It means the paper claims are growing faster than the actual physical supply that backs them. It means the people who take delivery, true large players, are stepping forward quietly because they know the future constraints will be far worse. And this is why expiration cycles matter so much. When large traders stand for delivery instead of rolling their contracts, they strain the system. It forces the bullion banks to deliver physical metal they never thought they'd have to deliver. And every ounce that leaves the system is one less ounce available for the next delivery month. Think about what happens when hundreds of millions of ounces are promised, but only a tiny fraction exists. You could short squeeze, not in price, but in reality. Now combine that with the fact that demand for physical metal is near records. Not demand for ETFs, not demand for paper, demand for physical bars, coins, vaulted metal. Demand coming from sovereigns, pension funds, wealth funds, and private institutions who are pulling metal out of the COMEX, out of the LBMA, out of Zurich, and into private vaults. This is not speculation. This is preparation. And you know what's interesting? The mainstream media won't touch any of this. They're too busy telling you how great the soft landing is, how inflation is cooling, how the Fed is data dependent, how AI will save the economy. Meanwhile, JP Morgan is hoarding one of the largest private silver positions in modern history. Citibank calls silver the most asymmetric trade of the decade. Bank of America's head analyst says 25% gold allocation is not overweight. That's not the behavior of people who believe the system is fine. That's the behavior of insiders repositioning before the public wakes up. And speaking of insiders, let's circle back to bridge because this one is being massively underestimated. The Western press pretends this isn't happening, but the East is building an entirely new global settlement infrastructure while the West is arguing about interest rates and arguing about who's going to run the IMF. The UAE China test wasn't a test. It was a signal, a quiet message. We're ready. 7 seconds to settle a cross-border trade that used to take 3 to 5 days. Fees reduced by 98%. No SWIFT, no U.S. intermediary, no dollar. And the most important part, settlement assets can be gold. For 80 years, the U.S. dollar was the choke point. If you wanted to settle global trade, you had to go through the dollar. If you wanted to move oil, you had to go through the dollar. If you wanted to move commodities, you had to go through the dollar. Bridge breaks that choke point. It replaces it. And it does so with a ledger that cannot be sanctioned, frozen, or manipulated by Western politics. But even more importantly, Bridge integrates directly with physical gold markets. Gold becomes the neutral reserve asset that lubricates trade. The Chinese knew exactly what they were doing when they built their offshore gold vaulting system in Hong Kong and now in Saudi Arabia. A closed-loop system, Eastern trade plus Eastern currency plus Eastern gold settlement. And that reduces reliance on the dollar. Not tomorrow, not overnight, but step by step, transaction by transaction, settlement by settlement. The cracks in dollar hegemony are here. They are visible to anyone willing to look. And meanwhile, the Fed is backed into the tightest corner it's ever been in. They talk tough, but behind the scenes they're injecting liquidity every single week. They're afraid to use the word QE because it brings back memories of 2008 and triggers panic. So they hide it behind balance sheet management. They hide it behind repo operations. They hide it behind treasury market interventions. But it's still QE. They're still adding liquidity because they have no choice. Because the system can't handle 5% interest rates in a world drowning in debt. And you can't blame Powell entirely. He inherited a burning building with a garden hose. But his problem is the same problem every Fed chair eventually faces: reality. You cannot fight math. You cannot fight the debt spiral. You cannot normalize interest rates in a system addicted to free money. You cannot unwind trillions of dollars in artificial liquidity without the entire system seizing up. So now they're quietly restarting the same process they once called temporary emergency measures 15 years ago. And the moment they cut rates again, gold and silver are going to explode. Not because of speculation, because of mathematics. Every time the Fed cuts rates, real yields fall. When real yields fall, the opportunity cost of holding gold disappears. Why hold one-year treasuries yielding 1% below inflation when you can hold an asset that has no counterparty risk and has outperformed every fiat currency for 5,000 years? And this is where the political pressure comes in. The administration needs markets high going into the election cycle. They need the illusion of prosperity. They need people to feel financially secure. And the only way to create that illusion is through cheaper money. So whether the Fed admits it or not, they're going to cut. And the metals markets know it. The insiders know it. The sovereigns know it. Wall Street is always the last to know. And then we have the wild card, quantum computing. You don't need to understand the technical details to understand the implications. If the cryptography behind Bitcoin and Ethereum can be cracked within the next 5 years, everything digital becomes vulnerable. Wallets, exchanges, private keys, smart contracts, NFTs, tokenized assets, even CBDCs. All it takes is one breakthrough from China or the US or Google or whoever, and the digital financial system is exposed. And who warned about it? The founder of Ethereum himself. When the architect of the crypto revolution tells you quantum computing is a threat, you should listen.